so anyway, Cindy and I connected a little while back. I was really impressed with her, I guess, knowledge, understanding, and heart to serve. She's been serving clients both in Greeley and in our region generally, but also on a national basis for longer than I should mention probably. But she agreed that she could bring a webinar to us this morning that really focused on the financial foundations. And I meet a lot of folks like through my consulting at Small Business Development Center and things. And most entrepreneurs haven't been to business school, you know, and so there's no easy way to learn it, but to do it. But if you can have that voice of experience guiding you, it can really be helpful. Before she gets going, I want to share a couple of things with you. We have a special event coming up April 14th. It's a fundraiser benefit that Local Think Tank is hosting, and I'll put a link to that in the chat here in a little bit. But it's my favorite band of Brothers Fountain is going to be playing music, and my favorite nonprofit locally is going to be making a small presentation, and we're going to have awesome kind of farm to table menu food. So it's music and food at Sweetheart Winery on April 14th. And we're asking for a $100 donation to the Matthews House to get in. So the sponsors are covering the costs there. And thanks also to Sweetheart Winery. And then up on Cinco de Mayo, the afternoon of Cinco de Mayo, it's not even on our events page yet, but Free Think is what we do to kind of share how we do what we do at Local Think Tank. And that is to build these effectively a board of directors for your small business. And so Free Think is May 5th. We're going to have that here at the local office. There might be tacos, there might be tequila. Yeah. I don't know. We'll figure that out, and that'll be up on our events page. So I'll just link to our events page after this as well. Keep that in your bookmarks or whatever, so that you can see what's coming up if we're not spamming you sufficiently with our notices. So all that said, Cindy, you're on. Thanks for joining us this morning, and thanks to all of you that are taking time to work on your knowledge of business.
Well, good morning, everyone. First off, I'm going to let you know that my assistant Elda is going to be monitoring the chat. So don't worry if I missed a question. She will make sure that I get it at the end. So don't worry about that. We're also going to be doing some pop quizzes through this. The first one that gets the answer correct in the chat will get a gift mailed to them. So and Elda will let you know if you won, so she can get your address so we can mail it to you. Okay, let me share my screen first. Okay, can you see? Can everyone see? Okay, so what we're going to be doing today is Financial Fitness 101. Now, I am Cindy Finkenbinder. I have been in business for about 25 years now. And I started out doing just bookkeeping and then moved into tax. And so most of my, a lot of my focus is making sure that your books match your tax return. Because if they don't, then you're going to have problems, especially if you ever got audited. So we're going to get started. Okay, here's the first pop quiz. In Rome, you paid a tax for the purchase of urine, which was used to clean wool. Okay. The Russian Emperor Peter the Great placed a tax on beards. That means at least two of you would be in trouble. England in the 1600s had a tax on windows. Property tax was based on the number of windows in a house. So they started using fewer windows, or all of the above. So which one do you think it is? Okay, I don't know which one was first, so it is D, all of the above.
Heather.
Okay, Heather, you get a gift. So make sure you get Elda your address. And they are really cool. The one that I always found fascinating was the Windows one.
Number you have dialed is either unattended or out of coverage area. Please try your call later.
don't know what that one is, but okay. So basically, what we're going to start with is the profit and loss statement. The profit and loss statement is basically a motion picture. Okay, it's going to change every day as you put information in it. Every time you put in an invoice, every time you put in an expense, every time you reconcile your bank statement, the picture will change. Okay. And so because of that, you have to watch your profit and loss statement a minimum of once a week. Check and make sure that you're on track. Now, this is an example of an income statement. I'm sure you've all seen a profit and loss statement, okay? You start with your income, and then you have cost of goods, which I don't have it in here, but this is just out of a demo company. Then you have cost of goods, which includes the items such as products. Sometimes it can include the labor to create those products. Sometimes it can include the building that it's in. Sometimes it can include things like utilities that have to be used to do that. Now, some people consider that cost accounting. Cost accounting is a very different, oh, sorry. I'm going to turn that off. Okay. Cost accounting is a very different animal than your normal accounting. But the reason for it is because most people don't use cost accounting very often unless you're in certain industries. If you happen to be in the cannabis industry, you are going to use cost accounting every day. If you are in things like investments, or if you're doing like hard money lending, things like that, you aren't going to have a cost of goods account at all. So you have to really watch what you're going to use. Now then, and then followed by that is your operating expenses. Operating expenses are the normal things that take to run your business. Office supplies, your rent, advertising, your bank service charges, all of that stuff. And then it comes down to your net income. Now, sometimes there's another category in here called other. Other usually puts in there things like your things like bad debts that you're writing off. In most cases, most of you will probably have an other one if you took out a PPP loan, because those are considered a tax exempt income. And because of that, it's not your normal income. So anything that's not normally part of your business will fall underneath that. And then you'll come into your net. Now, there are a lot of common mistakes that people make on their P&L. Overstating expenses is one of the most common. The most common one of those is interest expense. The reason for that is we have a tendency to put all of the expenses to either go against the loan or go against interest. People don't like breaking it out when they're doing on their everyday profit and loss statement. It's not a problem if you do that, as long as you make sure that at least once a year, usually at the end of the year, you adjust it to match the actual what you owe. Because otherwise your interest expense is going to be overstated, and then you're going to end up with having more expenses, lower taxable income. The IRS ever audits you and they find this on there, they are going to audit everything instead of just that one category that they were looking at to start with. So watch that one. Oftentimes I find personal expenses mixed in with your business expenses. This happens a lot, mostly because every one of us, including me, you end up at the grocery store, you grab the wrong debit card when you are go to pay, because for some reason every single debit card in your in your account is going to be blue. I don't know why, but it seems like they're all the same color, especially if it's from the bank. And so you have to make sure that you've got the right one. Now, if you accidentally grab the wrong one, don't panic about it. Just make sure that you put that expense to a distribution or to a draw account so that you don't overestimate your business expenses. One thing that is often considered a business expense by us that the government considers as a personal expense is meals and entertainment. Okay, you have to really watch that one. In order to take a business expense for meals and entertainment, you have to have your receipt. It will have to say on there who you were meeting with and what the purpose of the business meeting is. If you don't have that on there, even if you hold some big event and pay for the whole thing, if you don't have it written down on the receipt what that was for, then the IRS is going to consider it to be personal expenses, and you're going to have, and it'll be a problem. The other big one is when cost of goods is not broken out from your operating expenses. And you saw that on the income statement what I just showed you. Because what happens with that is that you tend to, and I'm just going to back up to it real quick. Some of these things, such as rent and utilities, can be used for your cost of goods. So you have to watch that. The biggest one to make sure is in the correct spot is the UDD. I'm not sure. Oh, okay. I was just looking at the chat real quick. These phones are going to drive me crazy today. Okay, so what happens is when you don't have your cost of goods broken out from your operating expenses, it's not a major problem on your taxes and things like that, but it will create it so that your books are not reflective of your company. And when it doesn't reflect what your company is doing, it makes it really hard to analyze what you're supposed to be doing on a day-to-day basis. It looks like there's some more people waiting to enter, so I'll let you get them in. Now, the other problem with a P&L is when you overstate income. Normally, this happens when you're transferring from one account to another, or I often find things like loans from business owners are put in as income instead of putting to a loan. This happens a lot when you have somebody reconciling your books for you and they don't see the difference between something that you brought in and something that is actually an invoice for income. So you have to really watch that a lot. Now, you also have to watch the accrual versus cash basis, okay? Now, accrual is the most accurate, but it's the least often used by small businesses. The reason why it is the least often used is because it actually requires a little bit more work to keep on top of it. What accrual means is that your income and expenses are recorded and recognized at the time it occurs. Basically, if you get in a bill from the telephone company and you just set it aside and then you pay it and you put that expense in at the time you pay it, then you are not using the accrual basis. What accrual does is it allows you to actually track the difference between what you have coming in and what you have going out. And it also allows you to do forecasting and budgeting so much easier, because then you know exactly what's happening with each one, especially forecasting, because there is no way to predict how much money you need to have come in order to pay the upcoming bills if you don't have the bills in the system to start with. Now, most small companies will use invoicing, which makes your book sort of a hybrid between an accrual and a cash business. If you're using invoicing in your books, but you're not putting in the expense at the time that you receive it, then your books are going to be offset completely. So you're not going to be able to actually do real forecasting and projections. Okay. Now then, the cash basis is the least accurate, but it's the most often used by small businesses. Basically, you record your income and expenses when you receive it or you pay it. So in other words, if you get in a check from a client, that's when you put it in. When you pay the bill, that's when you put it in. This creates now keep in mind that most businesses, even if you're on an accrual basis for your books, most businesses are on a cash basis for taxes. Most computer software will handle that and will give you both reports. So it's important to make sure that you use both or that you use the accrual version, because you can still get your cash reports for tax purposes and things like that. Do we have any questions? Come on, guys, you've got to talk to me.
There's a couple of people that are asking, what is UDD?
I don't know what that is. I think that I'm not sure where that came up at. Let's see here.
Sorry, but it is school.
Okay, I think it's a location of where she's at.
Oh, okay.
We need to type that so that we can screenshot, so we can say to that school.
Oh, the school.
Oh, okay. When it actually, that's a good point. When you're doing nonprofit type businesses, you have to remember that it is even more important to use the accrual basis, because when you are doing nonprofits have a tendency to use only cash basis. And when you do that, you have to make it, what'll happen is it is harder to make sure that all of your donors and the board of directors and things like that won't know how much money they need to raise to be able to keep up with the expenses for the company or for the nonprofit. So a nonprofit is actually more important to make sure that you have all of your income and expenses run on the accrual basis. Okay. So now then, another thing you can do with these is if you have your books correct and on an accrual basis, then you can run all of these reports. You can do margin reports, you can do analytical reports that you cannot do on a cash basis. Now, margins are different for each industry. So if you are in, say, the cannabis industry, and the reason I say is I work with a lot of cannabis clients, I work with mostly investors. Okay, so when you're in the cannabis industry, there are no key indicators for them. You have to make it just off of your own reports. But if you are in something like the beverage industry, such as craft brewing or any of that, there are tons and tons of averages that they publish every year that will give you a analysis of each and every one of your accounts. They will even go down to how much you should be spending on office supplies, utilities, everything. The most important one to look at in these margins is payroll. You never want your payroll to be more than 35% of your gross product, of your gross income. And then also, you never want your cost of goods to be more than 75% of your gross. Now, sometimes, so there's some industries that those numbers won't work, but 95% of the industries, that's what you're looking for. Now, your variance is a percentage of one period over another, or your actual versus your budget. This is used to see if you're on track for the year and to make sure that you're comparing to, a lot of people compare last year to this year. Now I'm going to tell you, this has been extremely difficult to do variance reports over the last couple of years, mostly because businesses have been all over the place. Some businesses are going out of business because of the pandemic, that they just don't have enough customers coming in. Other businesses are thriving so much that their prior year doesn't even come close to what they're doing now. So you have to, let's see, payroll. Yeah, payroll should not be more than 35% of your gross income, unless you've got some gross income put into your cost of goods. You have to really watch where you put payroll, because sometimes that will throw off your variance numbers and your margins. So be careful with that. So, but on these variances, you have to really be careful that you are actually comparing apples to apples. Because if you're comparing apples to oranges, it's going to be way off the grid, and you're not going to be able to actually compare what's going on. So if you have an extremely bad year and then you have a phenomenal comeback, comparing those 2 years is not going to give you any kind of information that you want. So you have to then go to your budgets instead of to your year to year. So you have to really watch which one you're using. Your net profit percentage is one of the most important percentages that you want to analyze every time. Now, what this is your sales compared to your net. So in other words, what your sales is compared to the bottom line number. Because what happens is that this will give you your percentage of how good you're doing. Because if you are at a loss, then you're, of course, don't have any money to go to the owners. On the other hand, if you have a $50,000 gain and you're putting that all to the owners, is okay, but that's also taxable. So you have to make sure that your percentages and stuff are ending up where you actually want to. Now, if you suddenly have a $50,000 gain that you didn't have the year before, you need to call your tax preparer immediately so that you can make sure that you get estimated tax payments and things like that done. If you are working with a tax preparer, and not necessarily a CPA, but EAs are really good with tax too. So you want to, but you want your tax preparer to make sure and check a minimum of twice a year, usually around July and November, to see where your business is at, to make sure that you have got the correct amount paid in on your taxes. The way they do that is off of this net profit percentage. So you have to make sure that not only are your books accurate, but this net profit percentage will give you the information that you need to know to be able to to be able to work through every single one of your products and your projects. It also allows you to do more planning, because if you know what your net profit percentage is, it will give you an advantage over the other businesses that are in your same industry, because knowing that profit percentage gives you an edge, because it allows you to know the differences, and it also allows you to know what kind of how much play you have in there to be able to take in things like the pandemic. Because without that profit percentage, a lot of businesses went under because they were right on the edge to start with. And so by making sure your profit percentages are high enough that you can absorb things that are happening, both bad and good, will give you a better advantage for your business. We also have the gross profit percentage. The gross is the amount of sales compared to the cost of goods. Now, the thing is that if you aren't tracking your cost of goods, you're not going to be able to use this percentage. Okay. So this is basically how much you're paying for product compared to the sales that is coming in. If this is a negative number, you are in trouble, because that means you're paying more, you're paying more for the product than you are getting out of it. You want this profit percentage to be high enough that all of it that you can pay all of your operating expenses in addition. There's really no good percentage for either one of these to make sure that you, so it's really hard to say, okay, well, you have to have it at 50% for your gross profit and 20% for net profit. It's really hard to say that. The easiest way to do it is to decide how much you want your take home to be, figure out what your net profit percentage would be, and go from there. So it really makes it a little bit more difficult. But once you've got all of your profit and loss based on your accrual basis, this is easy to figure out. So that makes it a lot faster and a lot easier. Okay, another pop quiz. What do the following people have in common? Al Capone, Pete Rose, Chuck Berry, and Martha Stewart. Yes, they were in prison, but for what? Anyone have an idea? Okay. Exactly. They spent time in jail for tax evasion. Now, then you have to remember that all of them did not intentionally do it. Most of them were relying on a tax preparer to help them to get through to get their taxes prepared. Most of them had relied on somebody else to do that. The reason I mention that is because if you are not looking at your books, if you are relying on somebody else to do this for you, then you are going to end up not necessarily in jail, but in a lot of trouble. Okay. I have come across a lot of embezzling and a lot of tax issues that were not caught simply because the business owner trusted the bookkeeper and trusted their tax professional and never looked at the books to make sure that the numbers were adding up the way they should. If you have an outside person doing your bookkeeping, doing your CFO work, things like that, and you don't look at the reports that they send you, then it is on you of whether or not you actually have your business under control. And you don't have to know the exact things. You don't have to be able to say, well, we spent, $500 on, telephone bills last year. Now, you do have to be able to come close and say, well, we should have been in the range of around 500. If for some reason your telephone bills are running, your books are showing that you actually paid 4,000 and you never looked at it, then you're going to have some issues. Okay, so make sure that you do not end up in jail for tax evasion simply because you did not look at your books.
So Jennifer is the one who got it.
Ah, cool. Okay, Jen, make sure that Elda has your address. And you guys are going to really like these little gifts. They are so much fun. Okay, so now then the balance sheet is the foundation. The profit and loss is your moving picture. Your balance sheet is more like a photograph, okay? It should not change after you have finished with that month. They should stay the same. If you run your report today for 12/31/21, and then you run it in 6 months and your number has changed as of the same date of 12/31/21, you have got a major issue. That should never change simply because you ran the report on a different date. So you have to make sure that your dates are always in there. Now, if your balance keeps changing, there's two different problems that you could have. One is you have an embezzling issue that somebody is trying to cover up. Or two, somebody did not reconcile the books correctly the first time and is trying to fix it. Okay. Now that second one is normally what I come across, especially with small businesses that have not reconciled their books every single month. Now, common mistakes. This first one relates directly to the one on the balance on your profit and loss statement. Not recording the principal loan payments. So if you don't record your principal loan payments, then you're overstating interest. If you record everything as interest, then you're not recording your principal loan payments. So you have to make sure that you've got both of them. Another one is not recording the depreciation on your books each year. When your tax preparer gives you a list of adjusting entries that need to be put into your books, put them in. These are not just optional things that we throw at you. The reason why we give you these adjusting entries is to record things that only happen once a year, such as depreciation, adjusting your loans so it's correct, these kind of things. So without putting those in, then your books are never going to match your tax return. If your books don't match your tax return and you are audited, then you're going to have to explain why they don't match. And then you've got an issue. Another big one is reporting capital items as expenses. If this one I see a lot, especially with people who have rental real estate. Now then, what happens is you go in, you replace the furnace, you put it in as a repair. It's not a repair. If you go in and you fix one part on the furnace, doesn't matter how much it could be. If you have to replace, one part of the furnace and then you still have the same furnace operating, you have a repair expense. If you go in and you replace the entire furnace, it is a capital item that has to be expensed. Every accountant that you come across will have a different threshold that they use for capital, whether or not they'll look at it as a capital item. Personally, I use 500. So if you pay more than 500 for it, we're going to look at it and see if it should have been a capital expense. If it's under, then you can put it in small tools or repairs or whatever you need to be. But you need to ask the person that's doing the taxes what their threshold is, because every single accountant has a different threshold. Mostly because there is no actual hard and fast rule that the IRS has told us. And so because of that, each of us looks at it a little bit differently. The other big one that I find is owner contributions versus owner loans versus owner distributions. You have to have owner contributions, especially the first year that you start. The reason for that is that that when you first start a business, you are going to put money into it in order to start it. There's no getting around it unless you do the whole thing off as loan, on credit cards or something like that. If you do not have owner contributions and you put all of it to owner loans, the IRS, if they come in and audit, are going to reclassify those. So you have to be careful. Now, owner loans, as opposed to the contributions, if you loan your company money, you have to do interest on it. Okay, just a second. We have a question here. Okay. Okay, when you're adding late charges or finance charges, you do not change the original invoice. You want to put the late charges and finance charges on the date that you charge it. Okay, so that, so if somebody, it's sort of like when you get a bank statement or a credit card statement, it goes through and it adds your interest or late fees or any of that stuff in that month. It doesn't go back to the month that that you actually put the bill in there. So you want to make sure that you put any late charges and finance charges and things in the current month. So you're not going to go backwards on that.
Can you actually read the questions so that everybody?
Oh, okay. The
Yeah.
question is, so what happens if we have to go back into invoices from previous periods to add late charges or finance charges? That changes our interest income and financial statements. For example, if we closed 2021 in January 2022, and then in February, we need to go back and change an invoice from December. Late chart. Now, there are some times when you do need to change an invoice. Make sure that if you do that, one, you do not do it in a year that you've already done taxes for, because that's going to throw your taxes off completely. And then you're going to have to redo them and amend everything. Sometimes, yes, you do need to amend a tax return, but most of the time, these are small changes that you don't need to go in and amend it. So you do it in the current year or the current month. Yes, put the finance charges on a new invoice. That works perfectly. And most tax software or most accounting software is designed that way, so that you do finance charges and things like that on new invoices. Okay, so we were on owner contributions versus owner loans. If you have an owner loan, you have to do interest. Now then you can put this interest amount as being a percentage that you choose. But if you choose it, you have to have documentation. That means actually having paperwork that we are going to loan the company this much money. At this interest rate, it is due on this date. We have to make payments on this date, things like that. So you have to have a real loan document. If you don't have a loan document, then it defaults to the current amount that you would get a loan from the bank. Right now, I think that's between, last I looked, it was only I think it's basically the amount that a bank would loan money to another bank. And so I think it was at 1.5 last month, but that's supposed to be going up a lot. Now, owner distributions or owner draws, this one is really, really important, especially if you have an S corp. If you have an S corporation, then you are required to have payroll for anyone that is a 2% owner or more. And so that requirement means that not everything can go into distributions and draws. You have to really watch that. If you have an S corp currently that you are not doing payroll for, give me a call. We will get it fixed, because you have to have payroll. If you don't, and what the problem is that the IRS just says reasonable payroll. They don't have any guidelines of what reasonable is. And so you have to, so most accountants that I know anyway, will use a threshold that your owner distributions cannot be more than half of what your payroll is. So essentially, in order to figure that out, the way that I have my clients figure it out is you take all of your normal monthly expenses, rent, groceries, you know, your mortgage, you know, student loan payments, kids, you know, clothing, your normal monthly expenses. And that is what your payroll is going to be. And then your distributions are anything that you would be doing over that, such as vacations, things like that. So you want to make sure that you've got your loans in there correctly. You've got your owner distributions in there, and you've got your contributions. If your balance sheet right now does not have those three things on it, we need to talk. Okay, this is your normal balance sheet. Again, this is from the demo company. Now you notice that we have, I did this on a quarterly basis. Okay, so this is December 31, September 31. If I was to run this again tomorrow, these numbers should be the exact same if it's ran on those dates. It'll give you your accounts. Now notice this is an accrual basis, so we have accounts receivable in here. We purchased a new computer. The historical adjustment is usually something that comes over when you're switching software. Accounts payable is that what you have to have going out. And you notice we do not have owner contributions and distributions in here. So we have to, so this amount is off. So we have to watch that. Basically, your total assets have to equal your total liabilities plus your equity. So this number is 18. These two numbers always have to match. Okay. If these are not matching for some reason and you're using a computer software for doing your books, you have an issue. Normally it is a corruption of the file, and we're going to have to really check that. Okay, different things that you need to analyze on your balance sheet. Your debt ratio. Can your assets pay off your debts? So if we go back to this one, we have 12,000 here. Our liabilities are 10. So we would be able to pay off our debts with our cash. So we're in a pretty good place there. The current ratio is that your current assets, which is basically cash, anything that can be converted into cash. So if you have things like land or buildings or anything like that, fixed assets in your on your balance sheet, those will not count because those are long-term. So you want to all your current assets to be able to pay off your current debt. Working capital to total assets. In other words, did you use your own money or did you use debt to fund your business? In this case, they used debt. Okay, the reason we know that is our accounts payable went up considerably. We have a computer on here, but we don't have any income coming in from the business owner. So they funded their entire business off of debt only, which is never a good idea. Because when you do that, then I have found that when you don't put your own money in and it's all debt, you don't have enough skin in the game to make your business profitable, because it's not as important as it is if your own money is in there. Pop quiz. Which of these are not deductible for your business taxes? Accounting fees, credit card interest, interest paid on a car, or animals? Okay, this is a trick question. All of these are deductible. Okay, in one form or another. And yes, that includes animals, but I will give you whoever had animals first will get the prize. Okay. So accounting fees are always deductible for a business.
Brianne,
Brianne got it. Good. Okay. Send Elda your information so I can mail it to you. Okay. Interest paid on a loan or a credit card that is exclusively for business can be deducted. The key there is exclusively. If you mix your credit cards, you have only personal cards and you just sort of mix them up of which ones are business expenses, you cannot use the loan or the interest on there. Interest on a car depends on the business use of the vehicle. You have to have a mileage log or none of it is deductible. It does not matter. It doesn't matter at all to the IRS. If you drive your vehicle 100% of the time, they assume that you are going to stop at the grocery store on your way home. You are going to take the business car to pick the kids up from school because that happens to be the car that you are driving at the time. No car, doesn't matter what kind of a vehicle it is, even fleet vehicles, you have to keep a mileage log. The best and easiest way to do this that I have found is an app called Mile IQ. Mostly because it will work even when okay, I have no idea what happened, but can you hear me? Okay. Well,
Yes, we can hear you now.
okay, that was weird.
yeah, it glitched.
Okay, so yeah, you have to have a mileage log. I don't care what kind of a business you have. Make sure you have one. Mile IQ works every time, even when you forget to turn it on. So, and it works on your phone, and it assumes that if you're going more than 5 miles an hour, then you are driving. Okay. Mostly because I don't know anyone that can run that fast. So that's what it assumes. Now, animals depends on the reason you have one. Okay. You cannot use a pet. However, a trained security dog can be used as a business expense. Yes, junkyard dogs are deductible. The key is that you cannot just say, okay, this is similar to like service dogs, okay, on your personal return. You can't just say that it's a security dog. If your dog loves to bark which I have one that she only barks when she's in the house. Don't know why. But if your dog loves to bark and is big, my dog is a Bernese Mountain Dog mixed with a giant Mastiff. She's only 9 months old and weighs about 90 pounds. She is a big, loud dog. That does not mean she's a security dog by any means whatsoever. Yes, she can intimidate people, but that does not mean she's trained. So it has to be a dog that you have proof that they are trained. They have gone through the attack training. They will only bark on command. They will, it is extensive training that these dogs go through. A junkyard dog generally doesn't have all of that training, but most of them, that is their job. They are not taken home. You don't put them in the car and take them home at the end of every day. They stay at the yard. They, search the perimeter. That's the only time that they would be considered a business expense. The same thing works on your personal taxes. If you have a service dog, it has to be a bona fide trained service dog in order to take it. Okay, are we running out of time?
We have 5 minutes left, Cindy.
Okay, well, I've got a lot of things here. Okay, so let's see here. Okay, I'm gonna go through these a little bit faster since we're running out of time. Cash flow, the lack or abundance of cash does not equate to profit or even taxable income. Your tax flow is literally the influx of money or outgoing of money. How much you're paying in taxes has no correlation whatsoever to cash flow. In this case, the cash flow, you have receipts from your clients, payments to suppliers, and then we have cash and cash equivalents. This is your beginning amount. This is what was cashed at, or how much you used, which matches this number. What you have at the end of the period and how much it changed. It does not equate in any way to your profit and loss. Do you notice that basically your cash flow statement is what combines your income statement and your balance sheet? So essentially what happens is that, and I know this is really hard to read, but essentially this number equates to this number, which then equates to your cash, and this number then equates to your cash. So this is basically an interim statement between the two. It allows them to actually work together. So it has nothing to do with what your income, or all it is cash in, cash out. Okay. Okay. Another pop quiz. Do you enjoy confidentiality with your accountant? Yes or no? The answer is no. Your accountant is not an attorney. Even if they are a CPA, they are not an attorney. They can be subpoenaed to court and forced to answer questions about you and your business. Confidentiality is not guaranteed, but it is implied. So make sure that they have a really good privacy policy. I didn't realize that those things stayed on there. Okay. Necessities. You have to reconcile your books every single time to ensure accuracy. A minimum of once a month. Ideally, once a week. Even better, once a day. You have to have separate bank accounts and credit cards for your business. Now, getting credit cards for your business is a little bit more difficult. So sometimes you have to get a personal card and designate it as business only. So make sure that you use separate cards for everything. Keep your documents, especially when you're loaning your company money. Ask questions. Ignorance of the law and the IRS will not protect you, so be careful. Above and beyond, software. The heart about every accounting system is the software that you use. I personally prefer Xero. I use it with HubDoc for document management and Gusto for payroll. Budgeting. We can do a whole class just on budgeting. So if you guys want a class on budgeting, we'll do that sometime this summer. Okay, because this is an art form. It is not a science. Okay, this is basically guesstimates. Remember, you cannot reach the stars if you don't know how to get to the moon to start with. So you want to make sure that your budgets are going to get you to the moon, because that's going to push you to the stars. Goals are essential. If you have not read the book, The One Thing or Atomic Habits, you might want to pick those ones up as soon as possible. Okay, questions. And I do offer a 1-hour free consultation. Just go to our website and click on schedule an appointment.
I think that's a good place to start. Thank you, Cindy, first of all, before I say any more, but these kind of principles, they take a lot of time. It is an art, not a science, budgeting and just understanding how their financial statements work together. So, be ready to invest some time to get great at it, but too many business owners neglect it for too much time, and then they try to fix it. And so that would be my encouragement, is don't let it get too far sideways on you.
Exactly, because once you let it go, then it's really hard to get caught back up. I have found that on average, if you reconcile your books at least once a week, it's going to take you between 10 and 15 minutes to reconcile your books. If you wait until the end of the month and do it just as one, and it's generally going to take you about an hour. If you wait until the end of the year and do it in a crush because you have to for taxes, it's going to take an average of about 8 to 15 hours.
Yeah. I think that's probably true, because you just don't remember what happened that long ago.
Exactly.
And things like that. Is that part of the problem?
That is 90% of the problem, is then you have to go look everything up, where you remember what you did last week, but you're
Right.
not going to remember what you did last month.
Cool. Well, we always honor our guests' time and our hosts. And Cindy, there'll be an amazing prize in the mail to you, perhaps in the way of a thank you card from me at Loco Think Tank, and maybe even a gift card, because I do sure appreciate the time that you spent with us today. And for all of
Do
you,
we have everybody's addresses that won prizes?
Yes, we do. I know that there's only one person that answered, but incorrectly, the last one. So I don't know.
Well, they tried. Go ahead and give it to them.
Okay, so it'll be JRV Garcia.
Okay.
So
Well,
make sure that she has your address, and we'll get you a gift in the mail.
okay, I'm going to stop this recording, and I hope you guys all have a great day. It's 10 o'clock sharp, and Cindy, thanks again.
Thank you. You guys have a great day.